Our project focuses on the cost and pricing determination methods and the issues that are involved with United Airlines.
Today we're going to be doing an executive summary, a company introduction, as well as talk about major products, services, and competitors, as well as financial statements, return on assets and return on equity, as well as assumptions and methods, and our findings and recommendations.
Cost and pricing determination is used to guarantee that a company will not only earn profit, but also ensure that all of their costs will still be covered. There are two primary pricing strategies, the first being cost plus pricing, which utilizes a fixed price as well as a fixed percent markup price. The second is market-based pricing, which uses an analysis of supply and demand for a certain good, as well as the prices of surrounding competitors. Our purpose was to ensure that United Airlines not only has competitive prices, but also fair prices for their customers. And we did this by looking at financial statements to predict the company's total outcome. This includes their fixed costs and direct costs, as well as whether or not this company is a financially viable investment. Our key finding from this was that United Airlines applies dynamic pricing to their tickets in order to maximize their profit. They use market-based pricing in order to stay competitive while also giving their customers as fair of prices as they can.
In the company introduction, United Airlines is a Chicago-based U.S. airline formed in 1930 as a merger of four other companies. Its parent company also goes by the same name, United Airlines Holdings. Before the merger, it was actually known as United Aircraft Transport Corporation and was founded by William E. Boeing, Frederick B. Rentschler, along with their other associates. But jumping forward in time during 9/11, the company recorded a loss of $2.1 billion, caused by not only a lack of demand, but also long-standing structural issues and labor issues. By December 2002, they ended up filing for bankruptcy, but emerged from it around 2006. Similarly, with the COVID pandemic, United had to reduce capacity, ground aircraft, and lay off tens if not thousands of employees due to the lack of demand. Similarly, it also recovered at around 2021 and 2022. By April 2025, in its first quarter, the company made a record revenue of about $13.2 billion and a profit of $387 million. In its second quarter, that revenue had jumped up to $15 billion with a profit margin of over $1 billion. The main service that United Airlines provides is their international and national flights to over 358 places, along with their associate cabins, whether that be economy, premium, business, or first class. Their competitors, though not limited to this list, is American Airlines, Delta Airlines, Southwest, and JetBlue, who also provide similar services. Now, due to the high initial investment needed to open the airlines, the market can be considered an oligopoly. Looking at the parent company's stock price, by October 2024, there was an increase in the stock price due to United announcing a 1.5 billion share buyback plan, along with strong third quarter 2024 results and a promising outlook for December. By March 2025, there was a dip in the stock price by 15.7% due to weaker market conditions. According to the CEO, Scott Kirby, this can be due to a 50% drop in government and adjacent business bookings, which represented 2 to 3% of the company's revenue, with some bleed over coming into the domestic leisure market. By March 2026, as the stock price rose again, it would dip again by 5.9% due to the ongoing war with Iran, driving up fuel costs and lowering travel demand. Looking at the income statement provided by the 2025 10K, right, where all these numbers represent millions, there is a 3.5% increase in gross revenue from 2024, with non-operating expenses being down by 56% compared to last year. The reason for this massive decrease is because United paid off $1.5 billion of mileage plus loans. or mileage plus bonds, which contributed to a 6.5% increase in their net income, or in other words, their profit. Looking at their balance sheet, they had a roughly 12% decrease in their current assets, or roughly 8% increase in their non-current assets, with 35% increase in their retained earnings, most likely due to the lowering of their non-operation expense and their increase in profits in 2025.
On this slide, we analyzed return on assets as well as return on equity for United Airlines, Delta, and American Airlines. Starting with United Airlines in 2025, the company reported a net income of about $3.36 billion and a total assets of $76.4 billion, with stockholders' equity at $15.3 billion. Using those numbers, we found that the ROA is about 4.5%, rounded to 5%, and compared to 4.3% in 2024. This small increase suggests that United became slightly more efficient at generating profit from its assets. For ROE, United's 2025 ratio is 22% compared to 25% in 2024. And even though the company is still profitable, the decrease shows it's generated slightly less return for shareholders relative to equity than the previous years. When comparing competitors, Delta's also performed the strongest overall, with an ROA of 6%, which means it was more effective at using its assets and creating profit, and its ROE was also higher at 24%, showing strong returns to shareholders. American Airlines had the weakest performance, with an ROA of less than 1%, meaning the company generated very little profit from its assets. And it had an ROE which was about 6.2%, which is also significantly lower than both United and Delta. Overall, United Airlines is performing reasonably well and improved slightly in asset efficiency from 2024 to 2025. However, Delta remains the industry leader in both profitability and efficiency, while American Airlines continues to lag behind the other two companies.
United Airlines' cost structure includes fixed costs and variable costs. Their fixed costs can include things like their aircraft leases, as well as their salaries for pilots, flight attendants, any mechanics or maintenance staff that is needed, as well as their corporate management. Their variable costs include things like fuel and in-flight services, so Wi-Fi, snacks, food and drink, and any paper products they're using, such as napkins, utensils, and cups. They operate on a dynamic pricing model, which means they're charging based on the demand. And they also use segmented pricing, which means they're charging different prices depending on different upgrades. So seat class, extra leg room, premium, as well as the customer's willingness to pay. Cost and pricing determination is the strategies that companies use to determine what their selling price should be. The major influences include things like demand, supply, and also what market they're in. There's actually only two main pricing strategies, and that is cost-based pricing and then market-based pricing / contemporary pricing. So cost-based pricing is a fixed markup that's added onto the cost of making your product or your service, and then market-based pricing is setting your prices in relation to other offers on the market, which is what we see United Airlines executing. Within market-based pricing, there's two different types. There's static and dynamic. United Airlines really operates with a dynamic pricing strategy. So that's a strategy where prices are changing in real time based on the demand, supply, and the market conditions. According to the official aviation guide, airline fares are influenced by various factors, including demand, seasonality, competition, route popularity, booking time, and even the passenger's own behavior.
Our primary assumption was that United Airlines has not only competitive prices, but also fair prices for their customers. This was tested by comparing average prices of flights produced by other top competitors, and then dividing the total amount of flights by the total amount of revenue earned. For an A321 Airbus that has 244 seats, United Airlines would have to sell each seat for approximately $128 minimum. However, this is where market-based pricing comes in and assesses the supply and demand for this flight and where it's going, and will create an additional markup percentage price. As a continuation of our methods, we decided to choose 3 days, 2 weeks apart from each other, in order to compare United Airlines pricing to two of their top competitors, which is American Airlines and Delta Airlines. Some of the elements that stayed consistent throughout this process was that all flights were booked from LAX to JFK Airport. All flights left around 8 in the morning, and all flights were booked for one adult in economy seating. The results showed that United Airlines had by far the highest dollar amount in markups at $425. The difference between Delta and American Airlines was around $4, and the difference between both of those compared to United Airlines was around $280. While United Airlines does have consistently higher prices, these prices are based on demand, which shows that United Airlines does use dynamic pricing when determining how much their tickets should cost.
We found that on average, if you're booking a flight the day before, United Airlines is going to charge you about $234 in their fixed costs to fly you, versus if you book a flight 2 weeks out or even a month out, they're going to upcharge you around $301. We believe that this occurs because United Airlines is really trying to fill any empty seats to make as much revenue as possible to cover their fixed and their variable costs. To them, earning any revenue is better than earning no revenue. For our break-even analysis, we assumed that the fixed costs were around $50,000 per flight, and our average ticket price was around $286, which we found using the $51.8 billion in passenger revenue and the 181 million passengers flown last year, and then our variable costs being $128 per person, which we found earlier. If you use the formula, you get around 316 passengers for their break even. And in our analysis, we're using an A321 plane, and that only holds 244 passengers. So in order to break even, United Airlines has to add fees in other places, such as upgraded seats, baggage fees, and even seat selection fees, so that they can break even and then eventually make a profit.
These are our key findings from our analysis of United Airlines. First, regarding whether United Airlines is financially viable for investors, which overall the answer is yes. United has shown strong revenue growth, increasing profitability, and healthy cash flow performance. While investors may still have concerns about volatile fuel prices and relatively thin profit margins, demand for air travel will always remain strong, and analysts continue to expect long-term growth for the company. Second, we looked at whether United Airlines prices are fair, competitive, and justified compared to competitors like American and Delta Airlines. Our findings show that United often charges slightly higher prices and may be viewed as less favorable by some customers. However, their pricing remains competitive overall because ticket prices across the airline industry fluctuate similarly and generally stay aligned with competitors. Finally, looking at the company's total financial outcome for 2025, United reported approximately $59.1 billion in operating income, with expenses of about $55.7 billion, resulting in a net income of roughly $3.4 billion. These results indicate that the company remains profitable despite the high operating costs common in airline industries.
For our recommendations, we asked 2 questions. The first being, how can United Airlines be more financially viable to investors, if not already? Typically, investors look for a 5% or higher return on assets, meaning that at a 5% rounded ROA, United Airlines is considered low to average when determining the financial validity to investors. However, they would be able to raise the return on assets by maximizing revenue per seat mile. In addition, they could also raise their ROA by minimizing their operating expenses. Return on equity is typically appealing to investors when it's between 15 to 20%, meaning that at 22% return on equity, United Airlines is highly attractive to investors. Our second question was, how can United Airlines make prices more competitive or more fair? United Airlines utilizes dynamic pricing, which allows the company to maximize their revenue per seat. United Airlines is highly competitive with other airlines. However, they would be able to make their prices more fair or more appealing to their customers by lowering the prices to an average compared to other competitors.
Overall, our conclusion is that United Airlines is a solid business model, as the company continues to grow its revenue and stay profitable while remaining competitive in the airline industry. Even though there are challenges like changing fuel prices and lower profit margins, people are still traveling consistently, which gives the company strong long-term potential. This project also demonstrates how important dynamic pricing is in the airline industry. United changed ticket prices based on demands in order to maximize revenue while staying competitive with other airlines like Delta and American Airlines. We also found that airlines make money from more than just ticket sales. Extra fees like baggage handling, seat selection, and upgrade seatings also play a big role in overall profitability. In the end, United Airlines has been able to balance profitability, competition, and customer satisfaction fairly well. And that's what makes it a strong example of how airlines manage both business performance and customer expectations in such a competitive industry.